today we're going to talk about escrows. Hey VettedVA, my name's Brendan McKay. I'm out of Bethesda, Maryland, which is a suburb of Washington, D.C. And I've been a member of VettedVA since August of 2020. And today we're going to talk about escrows. Escrows are frankly one of the more confusing parts of a mortgage. And start off right off the bat, the word is confusing. It's used in multiple instances throughout a mortgage process. If you're in California and you go under escrow, it means you're under contract to buy your house. If once you are under contract and you write an earnest money deposit check to escrow, and now what we're about to talk about is escrows for taxes and insurance. All the word escrow means is that it's your money that's held in an account managed by somebody else in your interest. So in this case, we're going to explain how escrows within a mortgage for your tax and your insurance bill work. And I'm going to use a loan estimate to help kind of explain it visually. So let's start looking right here. Okay. So here's a loan estimate. On the first page, I'm going to focus on this first part right here, estimated escrow. This is going to break down your mortgage payment. Here's your principal and interest. And here's the portion that goes towards taxes and insurance, okay? And your total payment down right here. So what happens is every month you're going to make your mortgage payment, and this portion of it, this $524, is going to be taken out of your mortgage payment and put into an escrow account. The lender manages that escrow account for you. It builds up every single month, and when taxes are due, they pay the tax bill out of that escrow account, and then it starts building up over again. The exact same thing happens with insurance, okay? Right here, you can see on your loan estimate, it's broken down property taxes and insurance. You can see this number, $592, is a little bit different. If you have an HOA, that would be the reason for the difference most commonly here. So don't worry if they're a little bit different. Your HOA is going to be paid outside of your mortgage, even though it's included right here. This is just so you show your total cost of homeownership, but you will pay your HOA on your own. Down here is the rest of the section for escrows for taxes and insurance. Up above, when you're paying your taxes and insurance, that's on a monthly basis, and you're prepaying for a bill that's coming down the road, okay? But at closing, you're typically going to have to pay the first tax bill, the first insurance bill, and a 3-month buffer on each of them, okay? The lender keeps that buffer in the escrow account so that when taxes inevitably go up, they have extra money in the account to pay the tax bill and then let you get caught up over time, okay? The easiest way to understand this is within just focusing on insurance, because taxes can get wonky. In different areas, it might be quarterly or semi-annual or annual, but insurance is nice and clean. It's always going to be annually. So at closing, you pay your first insurance bill. In this case, right here, it's $1,200, and you're insured for the next year. Hooray, you're insured. Now, despite that fact, on your very first mortgage payment, you're going to pay $100 towards your mortgage payment for your insurance bill, so that a year later, you've made 12 of those payments, and a year after closing, your insurance bill is going to be due again, and there's another $1,200 in there for the lender to pay your insurance bill, and on the cycle goes. And now you might be asking, well, hey, I'm always prepaid by a year. What gives? Like, I'm always paid in advance. And here's when you're made whole: when you sell your house. When you sell your house, let's say you sell your house and your insurance renewed 5 months ago. You're 5 months prior to you selling it, you're gonna go, hey, insurance company, my insurance just renewed for a year, but I was only in the house for 5 months. What gives? And they go, yep, you're absolutely right, homeowner. Here is a 7 months prorated insurance refunded back to you. They're gonna send you a check in the mail. And then you're going to go, hey, mortgage company, I made 5 mortgage payments, and part of that went towards an annual tax bill that never came due. What's up? And they're going, yep, here's your escrow refund. And then you have your 12 months combined, and you're made whole again. And that's really it. That covers everything on escrows. They are complicated, but when you kind of break them down like that, it's not so bad. So I hope that's helpful. Take it easy. Bye.